We got a guest, Rick, join us now. Ellen Zentner, Morgan Stanley Wealth Management Chief Economic Strategist. Also, Roger Ferguson, who also is a Scrooge and never wants to cut. Former Fed Vice Chair. I'll get to you in just a second. I threw down the gauntlet for Roger. That's not really true, Roger, but I'm sure even with this, what is positive news on inflation, you still think the Fed needs to wait to see more of what's happening.
No, I agree completely. I don't mind being called a Scrooge by you, Joe. It's okay. So, look, the answer is the core inflation number has moved sideways at 2.8. That's not exactly moving directly towards 2. Somewhat better news on so-called headline for sure. But I think the wait-and-see posture at this stage is still merited until we're sure that we're getting progress and that the uncertainty about tariffs starts to recede a little bit.
Well, if Paul Volcker is the biggest Scrooge of all time, probably. So you probably should take that as a compliment. If there's ever a Mount Rushmore of Fed chiefs, he'd be there. Ellen, this is a good number. Are you happy?
I think, look, this number, you're going to hate this. This number doesn't matter because the tariff effects are going to really start to show up in next month's number.
Next month? Oh, okay.
The Fed probably is going to cut this year. And I understand the wait and see, but you've got 3% growth last year. We're probably slowing to around 1% growth this year. And so inflation, they're going to have an easier time saying this is a one-off level shift in prices. And they're going to be able to look beyond that. And that's what they really want to do.
Is that because you think the jobs market is going to decline as a result, or you think just the GDP?
I think there's going to be some more slack, and there should be more slack in the labor market if we're slowing to 1% growth this year.
Why are we slowing? Uncertainty, all the things the tariffs did?
All
is it
self-inflicted? Of the things. Yeah. But the whole first half of the year is so volatile because you've got incredible pull forward of demand. So you have this explosive private demand, final domestic demand in the first quarter. You're probably going to have flat to negative demand in the second quarter only because you pulled so much demand forward. So average the two, and then the Fed will say, okay, we have a clear picture. You will get some more slack in the labor market. Look at how the tourism numbers are off so sharply. I mean, Canada is off sharply. You've got planes that are not full coming over from Europe. And so what happens when we start to hire for leisure and hospitality jobs in the summer, and we're hiring, but not as much as we normally do? That's negative. You're going to have some slack building in the labor market. It's going to be easier for this Fed to go ahead and cut, but not right now.
Well, it wouldn't be the end of the world if they did cut right now, though, would it? If you say they're eventually going to do it because something happens that's a negative, you'd want to take the penicillin early, wouldn't you?
This is what happens when you have board decisions, right?
Right. But and you think they should? You would not be opposed to cutting right now? You think if they're going to cut later?
If I were sitting there, I would be like, why would we cut? Things are okay. But I would absolutely have that forecast of cutting this year. I mean, when you make decisions by committee, you have to get a consensus. Yep. When things aren't falling apart, it's hard to get consensus.
Well, we'll never
but when
get
the
Roger,
unemployment rate starts moving, when it's clear that growth is slowing, they'll look through the tariffs and they will cut.
You agree with all that, Roger?
Look, I think there's a logic to the argument. I am not so convinced that they are going to cut this year. I hear the reasoning, and I can't say it's totally wrong. But they still have to keep an eye on inflation. And if inflation keeps moving sideways at the core level, call it 2.7, 2.8, doesn't feel to me like it's close enough to 2. We're not going to get, a real falling out of bed. Labor markets might ease a little bit, but we're already at something that looks like full employment. So I would say it's going to be wait and see meeting by meeting, and I'm not sure I'd pencil in 1 or 2 cuts just yet. It may well happen, but based on what I see today, I don't think it would be the end of the world if they're moving sideways for the whole year, if inflation is, in fact, staying roughly at core where it is today.
But here's what they're going to say. They're going to be able to say, and I absolutely, Roger, if they end up not cutting this year, I won't be surprised at all. But here's what they're going to be able to say. We're not easing. We're not cutting to stimulate the economy. Just the economy has slowed dramatically this year, and we don't need to have rates this high. So it won't be easing, it'll just be cutting.
Do either of you think
that's a subtle distinction between easing and cutting. It's a subtle distinction between easing and cutting. I think they're going to have to keep an eye on inflation. I think the rationale for cutting is we're highly confident that inflation is continuing to come down. At a core, inflation is moving sideways at 2.8. I at least think it's hard to make the highly confident inflation's coming down argument. But you know, just as she wouldn't be surprised if they didn't cut, I wouldn't be stunned if they did cut. But I think the data will give them permission to cut. And right now, wait and see is what the data is telling them to do.
Yeah, fair enough.
Do you have an estimate for the deficit this year? And you saw the reconciliation bill. I mean,
how about this is a I'm going to give you the absolute number.
Yeah.
Big and bigger.
And with this bill, next year would be big and bigger, and the year after that would be big.
Yeah. I mean,
so why not keep?
I think
maybe we should keep rates high.
If we add $4 trillion to the deficit, I think that will be a positive surprise to the market because the market's probably expecting closer to $4.5 trillion. But it's a big number.
This in a year?
When you pass the tax bill over a 10-year period, you're going to be adding $4 trillion or more to the deficit.
Over 10 years.
This is why the term premium. One of the reasons why the term premium is higher because we're expecting
a lot
of issuance.
Maybe we shouldn't cut just not to enable more of that. I think that's what Roger's always thinking. In the back of your mind, you're like a closet vigilante, are you not, Roger? I think.
You know, I think you gave me the
vigilante.
highest compliment, which is Paul Volcker. Paul Volcker is everyone's hero on this space, and so I'm happy to be associated with that name.
Yeah.